Welcome traders and enthusiasts to the first session of our comprehensive 3-part course on trading with price action strategies for trends and momentum. My name is Ali, and as the head of training and education at Errante, I'm thrilled to guide you through the details of price action and core components of trading strategies that focuses on the historical prices and patterns to anticipate future market movements. Today, we dive into the fundamental elements of price action, and this session is crafted to equip you with the knowledge to read the markets with a nuanced understanding, harnessing the strength of trends to make informed trading decisions. Uh, okay, but before we begin, let's ensure everyone is set up properly, and please confirm that your video and audio are working correctly so that you receive a clear voice and video feed. And if you encounter any technical difficulties, do not hesitate to reach out for assistance. Our goal is to provide you with an uninterrupted and enriched learning experience. So I will wait for a minute to receive confirmation about the voice and the video feed. Very well. Thank you so much for sending me confirmation. Thanks. Let's embark on this journey together with clarity and focus to unlock the strategic edge that price action provides. As you know, this course, along with other webinars we provide, are brought to you by Errante Broker. And as we proceed with today's webinar, I want to remind everyone that the insights and the strategies discussed are for educational purposes only. So none of the contents provided should be taken as investment advice or as trading signals. You're here to learn and explore the financial markets together. So please make sure to do your own research before any trading or investment decision, because the CFDs are very risky products and you need to do your own due diligence before making any trading decision based on your risk appetite, your capital, and also your financial knowledge. In this course module, we are going to cover a spectrum of critical topics designed to deepen your understanding and enhance your Forex trading skills. Price action basics, where we begin by grounding our knowledge in the fundamental concepts of price action and through studying and trading based on price behavior. You will learn to read the market's movements and make informed decisions, setting the foundation for all future trading strategies. And then we will explore the significance of gaps, understanding their critical role at the start of new trends and during strong movements within current trends. And these gaps are not just somehow, let's say, anomalies. There are signals that can dictate the pace and direction of your trades. Next, we will examine the characteristics of price movements, which are essential in measuring the intensity and speed of market changes. We also discuss how to identify a trendless market, which is just as important as spotting a strong trend, as it helps you to accompany the overall market more effectively. We will also delve into multi-time frame analysis, learning how to understand price behavior across various time frames using candlesticks. In a very basic term, because this is the first session of our course, and this powerful technique, however, allows you to see the larger picture and finer details of market trends that enables you to get better entry and exit decisions. And lastly, we will wrap up with interactive Q&A session during this webinar. You can just send me your question during the chat box, during the explanation on each slide. If it's related to the slide, I will answer you right away. If not, please wait until the end of the webinar, then we will review all the questions we received. Okay, let's start with the price action in Forex trading. We know in today's trading environment, navigating the Forex market demands more than just theoretical knowledge. It requires a practical understanding of price movements and market psychology. This is where the concept of price action becomes indispensable. Price action trading, as detailed by many price action traders, is not just about observing price movements. It's about decoding the ongoing narrative of the market. The essence of price action lies in its simplicity and directness. It allows traders to cut through the noise of numerous indicators and focus on what truly matters, the price itself. So let's start with the basics. Price action is fundamentally the study of price movements, and this approach helps traders understand the immediate direction of the market, offering insight into potential future movements. And it's the groundwork upon which informed trading decisions are made, emphasizing the importance of historical and current price movements. We should know understanding price action is crucial for several reasons. It equips traders with the ability to discern market sentiment, a reflection of the collective attitude of the market participants towards price movements. And this insight is invaluable as it aids in anticipating shifts in market direction, enabling traders to act rather than react. Next, the practical advantages of price action trading are numerous. As you see here in my slide, firstly, it simplifies analysis by focusing on price movements themselves, eliminating reliance on lagging indicators. This clarity enhances decision-making, allowing traders to identify precise entry and exit points. Moreover, price action trading is adaptable. It suits various trading styles and timeframes, from scalping to long-term investing. Lastly, it empowers traders to make decisions based on real-time data, a critical factor in the fast-paced Forex market. So the simplicity, the precision, and the adaptability are the advantages of price action, and we can consider them as the most important reasons that why price action method, or let's say approach, is very common, is very popular among traders, especially the retail traders, those who rely on let's say price charts. So mastering price action is not just about learning a trading strategy. It's about developing a keen sense of market dynamics. And this understanding is pivotal for anyone looking to navigate the Forex market effectively. So we will delve deeper into how to apply price action principles practically, ensuring you're well equipped to somehow interpret and respond to the market's language. In order to get there, first we dive into the opening characteristics of strong trends, an essential concepts for mastering breakouts and reversals that we will discuss in our next sessions. Here are most common characteristics of a strong trend. Firstly, a big gap opening is a clear signal. At the start of a strong trend day, you might notice a significant gap from the previous day's close. And this indicates a strong initial move right out of the gate, suggesting a potential trend day ahead. And next we have breakout gaps, and these are characterized by a strong trend bar at the start of trading day, indicating a powerful movement away from a previous price range or level. And I would like to mention the fact that gaps are usually more considerable in a stock market because Forex trading is somehow continuous trading environment. You have the markets operating 24 hours a day. So it means closing one session and starting another session usually happens simultaneously in that case. But if you look at the stock markets that usually works from the 8 to 4 o'clock in the local time of each country, then you will see that all the market influences usually have a very progressive and profoundly impacts on price determination on the opening of the each day. That's why gaps are more significant in stock trading. But it's worth to mention that we have measuring gaps and micro measuring gaps. Is another categorization of gaps. And these gaps are critical in showing the strength of the trend's continuation. Let's just start with the measuring gaps. Measuring gaps often see in the middle of a price move serves as a halfway point in the trend. It's like taking a breath before the market continues on its path. And this type of gap typically occurs after significant move has already happened and suggested after the gap an equivalent move similar in size to the move before the gap could follow. So the key characteristics of measuring gap include somehow occurrence, means they appear, they usually appear within a trend, not at the beginning or end, and often after a strong move. These measuring gaps usually indicate that trends continuation and can be used to estimate the potential length of the trend from the points of the gap. Let me mention that measuring gaps are a powerful tool for traders because they provide a clue about the extent of a trend's move, allowing for a strategic placement of entry and exit points based on the projected continuation of a trend. And we will walk you through the real-time examples for sure, but let me just complete the definition of each of them. The next one is the micro measuring gaps, and micro measuring gaps are smaller in scale but serve a similar purpose. They often appear in shorter time frames and signal the continuation of a trend with less significance than full measuring gaps, but still indicate that the trend is likely to proceed. And characteristics include first, size, smaller than measuring gaps, as we discussed, but noticeable in the context of short-term trends. Then they suggest continuation of the trend as well on a shorter scale, and may occur more frequently than larger measuring gaps, especially in highly volatile or fast-moving markets. And this is what we usually see in Forex markets. We see lots of micro measuring gaps during the trading session. In practical terms, both measuring and micro measuring gaps can be used to refine trading strategies. By recognizing these gaps, traders can first anticipate continuation, prepare for the trend to continue beyond the gap, allowing for position adjustments or new entries in alignment with the trend's direction, and then set targets. To use the gap as a reference point for setting profit targets. And it's a very common way among, let's say, scalpers or somehow other price action traders, especially with measuring gaps, by projecting the trend's continuation equal in size to the move before the gap. And the other usage of gaps is in risk management. We can use them to adjust the stop loss orders to manage risk and take into account the potential for trend continuation signals by the gap. Understanding nuances of gaps in the Forex market is pivotal for identifying the earliest stages of market movements. And diving into gap types is not just academic, it's about equipping you with the tools to discern market direction more accurately and swiftly. First, we have a breakaway gaps. Breakaway gaps mark the commencement of a new trend and usually follow a consolidation phase aligning with the direction of the new trend. And their appearance serves as a strong indicator of a market ready to move away from its previous stagnation somehow. And it offers a prime opportunity for entry before the trend fully developed. As you see here on my slide, if I zoom in a bit, for example, at the beginning of a new trend, you can see the new session just started with a gap to the upside by this small blue candle. And afterward, we see somehow accelerating upward momentum in the market. And then afterward, we have this long upside movement as a consequence of this market trend. And this is a signal that there is something just happened in the market that near to the previous market bottom, we see this upside gap. So it can be a signal of accelerating positive momentum in the market. And next one is the runaway gaps or continuation gaps, manifest mid-trend and are aligned with the ongoing trend's direction, reinforcing the trend's strength. And their accuracy, we can usually find them as a signal for trader to maintain or consider new positions in the direction of the prior or current trend, as these gaps suggest the trend's momentum is not only intact but likely to persist. To leverage these gaps, look for them during a trend's progression. They confirm that the market sentiment is still in favor of the current direction, providing somehow reassurance against the fear of premature exits. For example, as an example, you can see on this chart, during this downtrend, we see a gap, a very significant gap, but in the direction of the current downtrend. So this is a downside gap here, and afterward the market tried to fill the gap and then continues just the downward movement or downtrend. Next, we have exhaustion gaps. They appear at the potential ends of a trend and can precede a reversal. Unlike the other types, these gaps may not always align clearly with the trend's direction, serving as a somehow cautionary signal for traders. Recognizing an exhaustion gap is crucial for preparing to exit positions or for anticipating a trend reversal. This allows for strategic adjustments to capture potential gains from the forthcoming change in market direction. For example, as what again you see here in this example, you can see that at the end of this downturn, we have a micro measuring gap between these two sessions at the end of this uptrend, and then we see afterward the market just fell to the previous bottom here, and we see the upward momentum is waning. So The size and volume accompanying gaps further refine these insights. Large gaps with significant volume usually solidify the credibility of the trend signals. Whether it's the beginning of a new trend with breakaways gaps or the continuation with runaway gaps. Conversely, smaller gaps with lesser volume suggest a need for caution, as they may not provide a strong enough basis for decision making. By the way, analyzing gaps within the market's broader context, considering the trend phase, the volume during the gap, and let's say subsequent price action, enhances our understanding of market direction. While strong trends don't always announce themselves with gaps, the presence of a gap demands further analysis, and it's an invitation to scrutinize the market's current state and adjust strategies accordingly. Remember, guys, the goal is not just to recognize these gaps, but to use them as a lens to view the market's underlying momentum and sentiment. And the breakaway, runaway, and exhaustion gaps each tell a part of this story only. They help us to navigate the Forex market's complexities. However, we really need to combine this with other trading strategy and, of course, the market structure and market context. Integrating gap analysis into your strategy is about sharpening your ability to predict market movements and manage your risks. Okay, building on this foundation, let's delve into the critical aspects of price action and bar patterns, which serve as the language of the market. To have a closer look at the characteristic of a strong trend using the somehow candlesticks or bars. It's about interpreting these movements as significant signals that can guide our trading decisions, particularly in confirming the continuation or reversal of trends. First, let's take a look at the trend bars. These are the linchpins of price action analysis. The prevalence of trend bars moving in the direction of the prevailing trend underscores the control exerted by buyers or sellers. Recognizing trend bars is fundamental. They are not somehow mere movements, but strong indicators of continued momentum in the trend's direction. And this recognition provides a robust basis for our trading decisions, allowing us to act with greater confidence. As you see during the definition of a, let's say, trend bar means the candles or bars who are in the same direction with the market direction. As you see here, for example, each blue, we have an uptrend, and each blue candle is considered as a trend bar. And then we have a sideways corrections. One of the important characteristics of a strong trend is that following a trend line break, conventional wisdom might anticipate a reversal. This is a theory. However, the market often opts for a sideways correction instead. Far from signaling a weakening trend, this lateral movement underscores the market's resilience and its underlying strength to resume the trend. So, identifying the sideways corrections is crucial for traders, as it signals not the end of the trend but a pause, offering a strategic entry points for those looking to capitalize on the trend resumption. As you see here, after breaking this trend line on this slide, we see the market just goes into a period of range bound trading, and then the prices just gets back above the trend lines means we can expect the uptrend to continue. Another characteristics of a strong trend is failed reversals. These patterns are the market's way for reinforcing the existing trend's strength. Let's put it this way. When attempts to reverse the trend, like failed wages or spikes, do not succeed, it underscores the prevailing trend's dominance. Understanding these failed reversals is vital. They serve as somehow reassurance that the trend is not only intact, but also strong, guiding us to maintain or initiate positions in line with the trend. Means that, for example, when you see this range bound in the market, you might expect a beautiful breakdown to the downside and a very pretty reversal. But as we see here, we have not also a gap, but also, for example, here, we have not also a gap, but also we see the market doesn't have any intention to complete this range bound to the downside to turn it into a reversal pattern. Instead, the market just resumes the current upward trend. And you can expect this type of market structure happens a lot during a very strong trend. Okay, so let's continue with the other characteristic of a strong trend and go through the more details. The first, we have a sense of urgency in market participation. One of the hallmarks of a strong and persistent trend is the noticeable lack of opportunities for trend pullbacks. The sense of urgency among traders, where the market offers few chances to enter the trend at a more favorable price, is a clear indication of a strong trend. For traders, recognizing this urgency means acknowledging the trend's strength and preparing for swift action to capitalize on limited pullback. For example, you see we have a trend bars during this sharp upward movement or this spike, and usually this is a one sign of a very strong trend. This is somehow obvious, but the importance is that when you are looking to enter this type of trends, you may not find a good entry point because you see all the pullbacks are very somehow weak. So you need to stay for another characteristics of these types of trends, and that's the strong setup in pullbacks. Even when pullbacks occur within a strong trend, they often present strong reversal bars. These bars tempting traders to continue with the trend, and the signal not just the market's temporary retreats, but also its readiness to resume the prevailing direction. So identifying these strong setups in pullbacks allows traders to find confidence in the trend's continuation, and it offers a strategic entry points for rejoining the trend. For example, you see here after each pullback or rebound to the moving average as a strong resistance, dynamic resistance level. Here we see a very long red candle after any of these rebounds. It means the market is rejecting strongly, profoundly the further upside movement by keeping this dynamic resistance intact. And then, for example, here you see, and also Yes, you see here on this candle, on this long red candle here, a very long red candle followed uh, by other long red candle. And also you see the length of the body of each trend bar is significantly longer than the rebound candles. So this pattern suggests that we have a very strong sentiment, downward sentiment in the market in favor of the current uh, direction of the trend. And another characteristic is a characteristic of very strong trend is the appearance of weak signal bars during pullbacks. And these bars, while making pullbacks less attractive for reversal trades, serve as a somehow potent indicator of the trend's strength and duration. For traders, weak signal bars in pullbacks suggest that the trend is far from over, advising against betting on a reversal and instead preparing for continued trend momentum. For example, here you see during this uptrend, we have these dojis as pullback bars, and they are followed by this long trend bar body here that signals the reversal is not really strong here. So it's better to uh, somehow stick to the current direction of this uptrend rather than waiting for somehow a reversal signal. So each of these characteristics, urgency in market participation, a strong setup in pullbacks, and weak signal bars, provides traders with a deeper understanding of market behavior and momentum. So by applying this knowledge, traders can better interpret the signs of a strong trends on their charts, making informed decisions about when to enter or stay with the trend. And this practical application of theoretical concepts is what transforms good traders into great ones, allowing for nuanced strategy adjustments that align with the market's unfolding narrative. So please remember, the goal is not just to follow the trends, but to understand their underpinnings, ensuring our trading decisions are both informed and strategic. Because as soon as you see these characteristics uh, don't apply, can't be applied on a chart. So in that case, you might start to consider shorting the market, or let's say enter the market in the opposite direction, means waiting for a reversal pattern. The next element here is identifying a strong trends in technical indicators, and market resistance offers invaluable insights into identifying and confirming the strength of trends. In this slide, we delve into specific technical behaviors that signal not just the presence of a strong trend, but also its potential to persist, providing practical guidance for traders to apply these concepts directly to their charts. So let's start with trend bar closures and moving averages. We can have a good comparison between these elements, the candlesticks, and also a trading indicator like moving average to measure the, let's say, the strength of a trend. A compelling indicator of a strong trend is when price bars consistently close on one side of moving average without any consecutive closes on the opposite side. This behavior signals that the trend has a robust unidirectional momentum. For traders, this observation is crucial. It suggests that the trend is not only strong, but also stable, and it offers a reliable backdrop against which to gauge potential entries and exits. In that case, for example, you can just target each of these pullbacks or these rebounds as a good entry point in the direction of the current trend, for example. As you see, we doesn't uh, we don't discuss the shadows. We are just talking about the closing above or below the moving average, or let's say on one side of the moving average consistently. And next, we have breaking resistance levels or support levels. The ability of a trend to break through multiple known resistance or support levels, be the moving averages, prior swing highs, or another indicator like Bollinger Bands or trend line, and you name it. This is a testament to its strength. Each breach presents a significant moment of victory for the trend's prevailing direction, effectively nullifying potential barriers that could have halted its progress. Traders should read these breakthroughs as confirmations of the trend's momentum, offering opportunities to either enter or remain in position aligned with the trend's direction. For example, as you see here again, we have the trend line, we have the Bollinger Bands, and you see the after losing the downside momentum, prices just breach above the trend line, and then they breach above the middle line, also uh, the the middle Bollinger Band, and then also cross above the moving average, and they get themselves through the previous market top, and breaking of all of these levels is somehow strong, let's say, is a sign of a strong momentum in the market. So let's go through reversal attempts and continuation patterns. In the face of a strong trend, spikes or attempts to reverse the direction often falter, lacking any substantial follow-through. Instead of leading to a reversal, these failed attempts frequently morph into continuation patterns, further uh, further affirming the trend's direction. And this pattern of behavior is a clear signal to traders that the market's momentum remains with the trend, advising against bets on a reversal and instead preparing for the trend's continuation. For example, again, you can see here on this slide that we have a false break through the previous market bottom as a strong support level, and after and the confirming candle doesn't confirm this breakout because it's in the opposite direction of the breakout candle, and then we can consider it as a false breakout, and afterward we see the market keep moving upward and remains in the uptrend above the moving average as we see. So by integrating these technical indicators and observations of market resistance or support levels into our trading strategies, we gain a deeper understanding of trend dynamics. So this not only enhances our ability to identify strong trends, but also informs our decisions regarding entry and exit points, risk management, and also potential profit targets. So remember, the essence of successful trading lies in our ability to read and react to the market signals, and understanding these technical indicators is a crucial step in the process. Embarking on our next topic, we delve into the concept of multi-time frame analysis, which is a crucial approach in understanding price behavior across various time frames using somehow candlestick patterns. And this technique involves analyzing the same asset across multiple time frames to gain a more comprehensive perspective of the market's movement. In forex trading, utilizing multiple time frame analysis is essential for identifying overarching trends and critical support and resistance levels, which in turn refines the precision of our entry and exit strategies. Candlestick patterns play a pivotal role in this analysis. That's why we had two full webinars about candlestick patterns and the reversal signals that they usually trigger during a trend or during a reversal. They serve as tools to decipher market sentiment. So when these patterns show consistency across different time frames, they provide a robust signal of market direction and momentum. Excuse me. So understanding multi-time frame analysis is foundational for traders aiming to navigate the complexities of the forex market effectively. And now, moving forward, let's explore how to implement multi-time frame analysis practically in our forex trading endeavor. The first step involves selecting appropriate timeframes to analyze. A common approach is to combine a long-term perspective, such as weekly or daily chart. As you see, we have a daily chart here. With a short-term view, like hourly or even minute chart that we have, for example, 15-minute chart here. And this combination allows traders to align the overall market trends with their specific trading strategies. Analyzing candlestick patterns across these time frames is our next crucial step, and we look for patterns that either indicate a continuation of the current trends or signal a potential reversal. When these patterns are consistent across both short and long-term time frames, it serves as a strong validation of the market's momentum or impending shift. And then we just need to integrate these analysis into our trading strategy, which involves using the insights gained from longer time frame to ascertain the overall direction of the market trends. And simultaneously, the shorter time frame can offer precise entry and exit points, making our trading decision more timely and effective. And this dual focus maximizes our trading opportunities while aligning with the broader market trends. Very well. So as we wrap up our discussion on multi-time frame analysis, it's important to highlight the advantages and considerations of this approach. By broadening our, let's say, perspective across different time frames, we enhance our understanding of market trends and dynamics. And this comprehensive view also allows us to identify any conflicting signals, improving our risk management strategies as well. Yeah, excuse me. Yes, I just wanted to make sure that everyone can see the presentation. Very well. So the alignment of our trading actions with the overall market momentum uh, somehow facilitates it by this analysis significantly increases the accuracy and success rate of our trades. It ensures that we are not just reacting to short-term fluctuations, but are making decisions that are supported by a more extensive market narrative. However, it's crucial to acknowledge that this approach requires the somehow consistent review of multiple charts and time frames, which can lead to potential information overload. And successful application of multi-time frame analysis demands a disciplined and organized approach to chart review, ensuring that we can somehow, let's say, sift through the data effectively without becoming overwhelmed. In conclusion, I would say multi-time frame analysis offers a powerful framework for making more informed and strategic trading decisions in the Forex market, especially when you want to uh, skill up the price action approach in your trading journey. By carefully implementing this approach and considering its implications, traders can significantly enhance their ability to navigate the market's complexities, leading to greater success in their trading endeavors. So very well, as we draw the curtains on today's enlightening session, I want to express my heartfelt thanks to each one of you for your active participation and engagement. Remember, the path to mastery in Forex trading is a continuous one, and of course, everyone is step and let's say every step you take builds upon the last. So stay curious and keep practicing, and always strive to refine your approach with the knowledge you are gained. For more webinars that will delve even deeper into the nuances of Forex trading, especially the price action, stay tuned, please. We have a wealth of knowledge still to explore. We will go through the more practical strategies in our next session after somehow practicing these basics and concepts that we explored today. Thank you once again for joining us. Keep charting your course to success, and may your trades be both wise and prosperous. Until next time, traders, trade safe and stay informed. Thank you so much.